Hi, this is Dee with Brown Girls Invest Too. In my last video, I started an investing series. In the first part, I covered why you need to invest now. In the second part, I'm going to cover what a stock is and how it generates wealth, and also the types of stocks there are. Stay tuned. Now let's talk about what the stock market is. When I say stock market, I am meaning the U.S. stock market exchange. My home country is in the U.S., so that is the stock market that I am most familiar with. That is the one that I will be speaking of. So for those of you that are in other markets, you'll have to do a little more research to see what principles that I'm speaking of now may be able to transfer over to your home market. I'll name a few of the bigger markets to give you guys a jump start on doing your research. And by the way, these are in largest to smallest order. So the number one market is the New York Stock Exchange. Number two, the NASDAQ. That's also a US-based stock market. Number three is Euronext. 4 is Shanghai Stock Exchange. 5 is the Japan Exchange Group, also the Tokyo Stock Exchange. Number 6 is the Shenzhen Stock Exchange. Number 7 is the Hong Kong Stock Exchange. And number 8 is the National Stock Exchange of India. Number 9 is the London Stock Exchange. And number 10 is the Saudi Stock Exchange. Now, what the stock market is. The stock market is a marketplace where buyers and sellers meet to trade shares of companies. So again, I am speaking of the U.S. market. The U.S. market is regulated by the Securities and Exchange Commission, also known as the SEC. Publicly traded companies make shares available to anyone to buy and sell those shares on the open stock market. The way a company becomes public is by doing an IPO, or an initial public offering. So basically what happens is an investment bank takes on the company IPO. They own all of the initial shares and they offer them to the public for a certain price, and they say, who wants them? Then people like you and I buy shares at the initial offered price. I'll give you a couple of examples. In May of 2012, Facebook, also known as Meta right now, went public, and those shares were offered at $38. Meta is now about $481. Two other important IPOs was Alibaba, which broke all kinds of records in 2014. It didn't last long because Saudi Aramco is the largest IPO ever. The stock exchange system allows individual investors to buy and sell in a regulated environment, sort of like an auction. A company goes public to raise money to expand their business, and it allows investors like us to participate in the financial achievements and growth of major companies. So now let's talk about what a stock is. It is basically a piece of a company. It's a very, very small piece of a company. By buying one share of a stock, you are owning a piece of a company through your share of ownership, which is a type of currency that is backed by the company. Units of stock are called shares. So if you buy one share, you are buying one piece, and the company sells stock to raise funds for their business. You can own one share of a company, you can own many shares of a company, or you can even buy fractions of a share of a company. For example, if you take a look at Microsoft, which is ticker symbol MSFT, you can see that they're trading at around $408 a share. If you were to pay $407.54 right now, you own one share of Microsoft. There are 7.4 billion shares outstanding, meaning if you buy one, you're going to own 1/7.4 billionth of that company. You can also buy portions of shares. So if you don't have $408 right now to invest, you can put, let's say, $100 in. That's going to buy you almost 1/4 of a share. There are a lot of platforms that will allow you to do this, and I'll talk about that later in the video. By the way, if you are getting any value out of this video, I would really appreciate you subscribing to the channel and sharing the video with your family and friends. Now, let's get back to these stocks. There are different types of stocks you can buy. The first kind is common stock. This is what you and I will be trading mostly. With common stock, you're getting ownership in a company with voting rights. You will get one vote for every share that you own. Some stocks pay dividends, which I talk about often, so we'll cover that a little later. By the way, dividends are not guaranteed, but there are some companies that pay them consistently. If you want more information about dividends, I cover it extensively in the video up here somewhere. Common stock generate higher returns than most other investments, but those high rewards also come with higher risk. There is preferred stock, which you can purchase as well. Preferred stock acts like both a bond and a stock. You don't get any voting rights, and it does have a more stable dividend that is received before common shareholders would receive theirs. So in the event that profits aren't big enough where they can pay both preferred and common shares, stock owners, they're going to pay out the preferred stock owners first. And the same thing in case of bankruptcy. The preferred stock lenders are going to get paid out first. Preferred stock is less volatile, so it's harder to lose or gain value. So the main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders, while common stocks do. Preferred shareholders have priority over a company's income, meaning they are paid dividends before common stockholders. And common stockholders are last in line when it comes to company assets, which means they'll be paid out after creditors, after bondholders, and after preferred shareholders. The benefit is that you get to vote for the board of directors as well as company policy. This is just to let you know that these two types of different stock exist. You probably will only trade the common stock though. Next, you have exchange traded funds, ETFs, and mutual funds. Now, both ETFs and mutual funds track and invest in a basket of stocks and assets. Mutual funds are more complex in how they are structured, but they both track some type of index. Mutual funds are actively traded by a mutual fund manager, so they have higher fees to pay that manager. ETFs are passively managed, so this makes them charge much lower fees. ETFs can also be actively traded throughout the trading day, but mutual funds are priced and traded at the end of the trading day. Stocks are categorized according to size. There are large cap or large capitalization, there is a mid cap, and there is small cap companies. Market cap or market capitalization is the total value of the company shares combined. A small cap company is going to be a company valued at between $300 million to $2 billion of market cap. Mid cap is going to be between $2 billion to 10 billion. A large cap is going to be anything that is 10 billion or larger. You can also categorize stocks in terms of sectors. There are 11 sectors. For example, there is my very favorite, the tech sector stocks, right? You can have healthcare stocks, consumer discretionary, consumer staples, and all of the rest. Again, there's a total of 11. You can also categorize by location. So you can have companies based in the US, Japan, Canada, China, and so on. You can also categorize a stock as a growth versus value stock. Growth stocks can possibly outperform the market due to future potential. These are usually going to be tech stocks like Nvidia, Meta's Facebook, Apple. With growth stocks, they have the potential of gaining a lot in value, but they are also more volatile and riskier. But tech tends to move the market. And when compared to value stocks, these are companies that are currently trading at a discount. And on a risk-adjusted basis, value stocks actually outperform stocks historically. But this does not necessarily mean that value stocks are exclusively better than growth stocks. So usually people like to invest in a combination of both. It really depends on your situation, your risk tolerance, as well as the time frame of that investment. In the third part of this series, we're going to talk about setting up a brokerage account. We'll talk about account types and timing the market. I hope you enjoyed. Like and subscribe to my channel, and I'll see you in the next video.